Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Peter Brandt, founder of Factor Trading. Hi, Peter. It's great to see you.
It's great to see you, Maggie. It's great to see, your
Yeah,
face is
yeah.
always good. It's always I always learn something whenever I turn in and,
Oh,
and see
I'm
your
the
guests.
one.
And
I'm the
great
one who
discussions.
learns. I'm the one who learns something. We all do when we have the pleasure of having you with all of your expertise that you bring in the years of trading and wisdom. So this is going to be fun. And you are joining us from your lake house. Thank goodness you're getting a little cool weather. So it's not your usual setup though. So we appreciate you taking a break from the lake, so to speak, to join this lake and give
Yeah,
us some.
from Lake Minnetonka to Maggie Lake. So,
Exactly. There is a Maggie Lake, by the way, somewhere up in the upper
oh
Midwest.
yeah, in Minnesota, there's got to be a lake named after everybody.
That's right. That's right. Okay, so uh, I want to. I messaged you, and I would like to start. We're going to look through some charts and some levels, and it's a good time to do that right now because we were in this little period where it feels like everyone's kind of getting ready for the next shoe to drop. So I'm really curious about what you're seeing in the charts and the framework you're developing as we head into the fall. So go ahead and if you want to start sharing your screen. And if we could start with the dollar, I asked you to start with this because I don't know if you remember, but one show we did together, you said, I like to look at the dollar because if I get that right, a lot of other things make sense to me. And it feels like there's been so much movement. We've seen this big devaluation in the dollar, losing ground against a lot of other pairs. And I know we're going to talk a little bit about pairs, not just the broad Dixie, because it matters what you're talking about dollar versus the other currency. But what are you seeing when it comes to the US dollar, Peter?
Well, yeah. I mean, let me just point out a couple things on this chart that are interesting because I really want to talk about what I think is really a misunderstanding of the dollar. When people talk about the dollar being a bullish trend or bearish trend, or you want to be bullish on the dollar, you want to be bearish on the dollar. I think there's a lot of misunderstanding of things that get priced in dollars when we think about dollars. I mean, if you'd ask anybody out there, how has the dollar done over the last uh, 55 years, everybody would say, oh, the dollar's been smashed. The dollar's getting smashed. The dollar's terrible. But on this chart, if you go back, this first X, this is Bretton Woods. This is the U.S. coming off of precious metal standards. Since the U.S. came off of the precious metal standards, the U.S. dollar index, now that's a trade weighted, the value of the U.S. dollar versus other currencies. That's what we always have to remember when we look at a chart of the US dollar. We're looking at the dollar versus other fiat currencies. It's a relative fiat currency perspective that we see. And
Mm.
so over the last 54 years, we've seen the US dollar really drop 17%. Now, 55 years, 17%. That's not exactly what I would describe as a collapse in the value of the US dollar. That comes out to 30 basis points a year. That's not super terrible. Now, the second X, this is, really the formal introduction of the euro currency. And of course, what we see here is basically the same sort of thing. Yeah, the dollar is down since the introduction of the euro currency, but not down based on what people have kind of been led to believe, that we have seen this massive devaluation of the US dollar. Because again, remember, Maggie, when we look at the US dollar, we're looking at it in comparison to other fiat currencies.
Mm.
Now, there's another way to look at the dollar, not in comparison to other currencies, but the dollar as a purchasing power. When we think about the dollar, we really need to think about what is the dollar worth in terms of what it can buy. And here we have the US CPI. This is Urban Consumers All Goods. When I was born, that's a long time ago, maybe 1947. When I was born, a dollar was worth a dollar.
Mm.
The dollar is now worth somewhere between 3 and 4 cents. I have some nieces and nephews who have been born in the last couple of years. the dollar for them is worth $1 at their date of birth. The dollar for them when they're my age is going to be probably worth the same thing. That on a purchasing power basis, yes, the dollar has been tanked relative to other currencies. So whenever we're thinking about the dollar, we need to think about the dollar in terms of how the dollar translates to other currencies. We also need to think about the dollar in terms of a store of value in purchasing power. Let me point out again, we look at the CPI chart, but let me point it out a slightly different way here, Maggie. And I'm going to look here at the dollar in relationship to inflation, to the CPI. When we look at the dollar in relationship, the stock market in relationship to the dollar, what we have seen is that the stock market has done well in relationship to inflation. Not tremendously well, but on a relative basis, the stock market, and this is S&Ps, has advanced plus 430 basis points on a compounded annual rate of return relative to inflation itself. What people don't think about is you often hear people say, well, the dollar is going to get tanked. The dollar is going to be weak. Therefore, I want to be bearish on the stock market. I want to be bearish on the stock market because of U.S. debt. That's the wrong way to think about this, Maggie, because when you think about it, when you buy stock, in effect, what you're doing is you're going short the U.S. dollar. Long the stock market is a short U.S. dollar play, but it's a short U.S. dollar play in terms of purchasing power, because when you buy stocks, what you're doing is you're taking U.S. dollar and you're converting those U.S. dollars into another asset. In this case, it would be the S&P 500. And there we see that over time, the S&P does quite well as a store of value relative to inflation. Now, again, people aren't going to say, 4.3%. I mean, that's not tremendous. That's not the type of thing investors are looking at. But first and foremost, an investor has to think about protecting purchasing power. Only after solves the riddle of protecting purchasing power can an investor then go on and look, okay, now I want to add alpha to the protection of purchasing power. And so I think it's important, again, to remember when we talk about the U.S. dollar, are we talking about the U.S. dollar relative to other currencies? Or are we talking about the U.S. dollar relative to its translation as a denominator of other assets? And so I think that's a good stake to pound into the ground.
And I just want to underscore, you just said something really, really important. And that is that your first job is preserving your purchasing power. And then you look to add alpha on top of that. So it's sort of, we think about maybe capital preservation. That's not exactly the word you use, but you want to make sure. So it sounds like store of value first, right? Find out what makes interesting to hear you say stocks are a fairly good store of value, because most people kind of equate them as risk assets.
No, it's a great store of value. You're buying the ability of a company to earn money. And you're buying dividends, you're buying profits, you're buying technology, you're buying future ideas. U.S. stock market, I've never understood this mentality that the dollars are going to get slammed. Interest rates are going to go out of control. The U.S. continues to print money. Therefore, you need to be bearish to the stock market. It's quite the opposite. All the more money that gets printed reflects itself in CPI, and that really drives the store of value home on the S&P. Now, keep in mind, we've got big fluctuations against some sort of straight line norm here, Maggie. When we look at this, even when you look at this right now, should we return to this midline that you see here on the S&P CPI ratio, we're talking about a 30% decline in the S&P. And so when we think about a store of value relative to the U.S. dollar, relative to purchasing power, again, there are times when the stock market's overpriced. There's times when it can be grossly underpriced, such as we saw back here in the early 1980s, when at the time the Dow Jones was trading at less than 1,000. But nevertheless, over time, I believe that equities, good quality equities, are a wonderful store of value. In other words, protecting the purchasing power of the U.S. dollar. And so, again, it's a store of value. The stock market's a store of value play. I want to talk about where I think we are right now in U.S. equities. And again, some people may look at the Russell, some others may look at the NASDAQ, but I think the place to start always is the S&P 500. I mean, we've heard Warren Buffett say that if you want to get wealthy, someone wants to get wealthy, save as much money as you can every month and put it into SPY. I believe that story. I mean, when I'm a trader and people often come to me and say, talk to me about trading, Peter. And I'll say, trading's not for everybody. If you've got a good job as an engineer or you're a physician, you're a skilled tradesman, you really don't want to be a trader, but you have money to invest and you're living within your means and you're saving money monthly and you're 20, 30 years old, I just say, put in an SPY. Put 80% of what you can save into SPY. And in 30 years from now, you're going to be worth a lot of money. Because I think SPY, the S&P, is a store of value, but it doesn't go up every year. I want to point out something here, Maggie, that I just find, super interesting, is that in the 1920s all the way through the 1940s, we saw the U.S. stock market, again, reflected in the SPX in this case, go nowhere. We had 32 years of no progress in the U.S. stock market as represented by the S&P. Of course, the S&P is kind of, you have to manufacture the numbers going back, too far back because there wasn't an S&P index as such, but we can fabricate it. We can come up with a proxy. Then we had, once we go into new high grounds, we had 10 years of advances followed by 17 years of no progress. If you're an investor in U.S. equities, yes, it's a long-term store of value, but it's a long-term store of value. Is something that you put your money in and you save it and you hold it over time. Then, of course, we had the big breakout in 1982 with Reagan, and we saw, again, 17 years of advance followed by 16 years of no progress. Now we're in 13 years of advance. My own personal opinion, Maggie, is everybody wants to either be a bull or a bear in the stock market. How about being neither? How about looking at the stock market as a big trading range, which I think could be quite likely? My forecast for the stock market for the next 5 to 10 years is no progress. That we can take a midpoint of the S&P at, let's say, 5,500. Of course, we're trading above that now into the low sixes. But if you take the S&P at 5,500, I think we're going to be plus 25%, minus 25% of that number for the next 5 to 10 years. And so what that tells me is if I am a believer that U.S. equities long-term are a good store of value, it'll protect your assets. Look for opportunities when the market is weak. And I think we're going to see some opportunities in the next 5 to 10 years as the S&Ps go into one of these yellow boxes, no progress. We will see the market on both sides we'll see moving averages flipping up and flipping down, but we could very well see S&P is somewhere between, let's say, 4,000 and 7,000 here for the next 5 to 10 years. So there'll be some great buying opportunities, but I am not looking for a collapse in the U.S. stock market, mainly because I'm not looking for a collapse in the money supply. And the money supply drives CPI. CPI drives store of value.
Interesting. So what about the Nasdaq in tech and this idea? There's a lot of people who love to hate the Mag 7 and feel like that so much of the gains were, sort of pulled from the future, and that this thing is going to kind of blow up. The bubble's going to burst. The AI bubble's going to burst. The tech bubble's going to burst. The risk asset bubble's going to burst. Call it what you will. You allow for the fact that there could be some downtrends that are buying opportunities, but you don't see this sort of massive collapse, or do you?
No, and that again comes back to people I might talk to. They're in their late 20s, early 30s. They have a good profession going. They're living within their means. They own their home. They're trying to save money. They're trying to invest money every month as much as they can. Is they go, well, I'm worried about the stock market. And I'll go, don't worry about the stock market. You want the stock market to have as big a correction as it can be, because you want to average down your average price of SPY. Now, the same thing can be held, let's say, of QQQ or NASDAQ futures or whatever the case may be, is we have a lot more volatility, of course, in tech stocks. But we are in the age of tech. And so it's really a question of finding emerging technology companies, because I think just as the long-term trend in Fortune 500 type companies, S&P 500 type companies are going to be long-term historical uptrends, I think the same thing will be true for NASDAQ. I think NASDAQ's a little overheated here. I mean, quite frankly, I think it's 5%, maybe 10% overvalued. And just as I think that we could see the S&Ps go into a plus 20, minus 20% trading range from some figure, 5,500, call it 6,000, we could see the same thing happen in the NASDAQ, where you just get some sort of natural rotation. That there's obviously companies out there that 5 to 10 years from now, people are going to be talking about in the same way they're talking about the high flyers today. I mean, that's just true of the tech world, is you get replacement companies that come in and become the next giants. And so, it's a question of finding those next emerging giants within the tech world. Of course, everybody's, super bullish on AIs. I think they should be. I think AI is going to have a major impact on the economy, and it's a major impact on the investment world. Now, will all the gains in the next 20 years, should the market advance in the next 20 years, all come from a very small, limited number of stocks? No, I think we're in that right now. I think long term, hey, Russell, there's a lot of good quality companies that aren't doing technology. They're pouring cement, they're moving dirt, they're pounding iron, whatever the case may be. And so I think the natural thing we've seen in the stock market over the last 90 years since the Great Depression has been this kind of rotational thing, where you have a time where your emerging economies are the ones that are ripping. There's a time when Asia's ripping. There's a time when we move to small tech, and small tech companies will lead large tech companies. Russell will lead the S&P. So we'll have those natural rotational moments. But again, no matter what index you're focused on, you look for periods of weakness to buy. So that's my view of the stock market. Long term.
Before we move on, do you think that we are in a rotation now where international markets are likely to outperform the U.S. if we're sideways at best, with potential gaps lower?
Yeah, I am very constructive on the Euro Stoxx Bank Index, which I'm a futures trader, Maggie, so I look at futures contracts. Euro Stoxx 50, it's a good contract in Europe. They also have subset contracts. Euro Stoxx Banks, I think, has wonderful opportunities. I am very constructive on Japan. I own the Nikkei futures in Osaka. I think there's a 30% upside over the next few years in the Japanese market. So I think Asia reignites at some point. Now, obviously, the big dog has been the U.S. I mean, the U.S. drives the world financial markets. That's not going to change. I mean, the U.S. has the entrepreneurship, the capital ability. You look at the New York Stock Exchange, there's no other stock exchange in the world that even comes close to the type of volume that we see traded in U.S. stock exchanges. And I think that'll remain true. But I think we'll have periods where I think Europe is a good place to have money right now. And so I think investors have to be alert to opportunities that take place in other markets. Again, I'm looking at Japanese stocks. I know Warren Buffett has been very, very big on the Japanese trading companies, 4 or 5 Japanese trading companies. I think that's reflected in kind of my enthusiasm right now for owning Japanese. So, but again, I think ownership's the key. Ownership. I don't want to chase after and place all my money in single bets. I mean, I'm a diversified guy. For me, I only risk 1% of my capital in any given trade, whether that's stock or a futures contract. But I think long term, especially for people that are just beginning careers, not necessarily for people my age that are approaching 80, that's a whole different story. But for people that are in their earning years, are putting money away, I think stock markets, equity markets are a wonderful place to be.
Let's talk about, and I cannot, no one can believe you're 80, Peter. That's just extraordinary.
1 year, Maggie, 1 year.
Well, almost. Okay. It's an incredible milestone. So for people who are a little bit closer to needing the money, to retiring, who are worried about losing what they've built up, the whole store of value is so important at this point. So what do you want to look at next? I don't know. I know gold is something that we'll likely get to, but I don't know. Where do you want to go from here?
Yeah. I want to go over to Bitcoin because,
okay.
digital,
tell me, do you think
especially younger? Now I'm getting into the people that I'm telling to buy SPY, and they say, no, Peter, no SPY for me. None of this boring stuff. I'm all into the crypto world. And so I want to touch on that. And actually, I am in Bitcoin. I own more Bitcoin than I own any other individual, not asset class, but individual equity. And I have been an owner of Bitcoin. I want to point something. Bitcoin to me, Maggie, is I kind of pinch myself that I've been able to be alive and trade during the Bitcoin world. This is a market like no other. I mean, if you look, and again, people will say, well, what about my junk coin over here? That's outperformed Bitcoin, and I'm all in XRP or Ether or whatever. None of those would exist if Bitcoin wasn't around. And so Bitcoin makes everything else possible. For me, Bitcoin's crypto, crypto's Bitcoin. Now, you can have side steps into some of this other fancy stuff and NFTs and all of that. But I think in terms of the store of value story in crypto, it has been Bitcoin. But Bitcoin's been a high flyer. I look at Bitcoin on a log chart, Maggie. I don't look at any other, at least weekly chart, for instance, on a log chart, except for Bitcoin. Because if you look at Bitcoin, Bitcoin is in its 5th parabolic advance on a log chart, where on a log chart you have 5x, 10x moves, 15x moves. I have looked through chart books. I can find no other equity stock, whether it be Apple or Nvidia or any other thing, where you can say over the course of a 15-year history, you've gone through 5 parabolic advances and you've taken an asset from basically $1 to $120,000. This is unique. But the interesting thing to me, and I'm going to point out a couple of things here, Maggie, is everyone talks about the halving, where you have those events in Bitcoin where fewer can be mined, where you half down the new mining. There's a wonderful cycle. And, cycles, once they get established, of course, are made to be broken the next time around. But until they're broken, you have to pay attention to it, Maggie. When you find a good cycle in the market, for me, I'm going to assume the cycle is going to continue until it doesn't continue. And if you look at Bitcoin, and I look at Bitcoin cycles different than most people, I look at Bitcoin cycles from the high point to the low point, then the next bull market cycle. So I'm looking at cycles from lows to highs, lows to highs, lows to highs. There's some really interesting cycles, Maggie, here, where if you take the low point of a Bitcoin to the high point of the Bitcoin bull market cycle, what you will find is at that point at which you had your halving date is exactly halfway in that cycle from bear market low to the next bull market high. Wow. Within a week or two. I mean, it's very reliable within a week or two. And so you talk about halving in terms of availability to mine, but you also turn, for me, halving in terms of the halfway point of a bull cycle. And so, and we also have this, and I call it the perfect banana. I can find no other chart that gives me a configuration over the entire price history that is so well contained by geometry. I mean, this is absolutely, the big banana is absolutely amazing to me, is that we've had entire prices contained within this upper parabolic curve and the lower parabolic curve, which do come into convergence, by the way. And so I look at Bitcoin as something that's going to have a big awakening. Its moment is coming. But again, looking at the halving, I'm looking for a bull market top in Bitcoin to come in late August, early September, which then would correspond to every other bear market low, the bull market high, halving cycle that we've had during the history of Bitcoin. And I think that the bull market is going to be contained by the big banana. And so I'm thinking Bitcoin's going to top. And I go back to something that I put on my blog in June of 2024, where I took a look at this pattern, Maggie, and I said Bitcoin's going to top in August, September of 2025, somewhere between 125 and 150. We're in that window now. And so I think Bitcoin's, but again, I think Bitcoin's a long-term store of value. I like the Bitcoin narrative, but I'm looking for a Bitcoin top followed by another big Bitcoin correction. Could take it all the way back down to 80 or so, 70 to 80. So that's a look at another store of value. You take dollars.
The Bitcoin, so when it goes down, you sort of mentioned that banana is converging. You can see that on the chart. When it goes down to the 70 or 80, is the range getting tighter? Are we over the parabolic moves, or are we going to see it broaden back out again somehow?
Well, that's an interesting question. I mean, hey, I'm a chartist, and I'm the first person to admit that charts don't predict. Charts show where we've been and make a suggestion on what's possible.
Right.
I mean, that's what charts are. I'm a chart trader, but I'm a chart swing trader. And so when we talk about charts, there's no magic in charts. The value of charts is to look and say, here's where we've been, and then to possibly identify an asymmetrical situation, which I think you could have. Now, I'm not a big person on looking at a chart and then creating a macro explanation. I avoid that. I discourage other people from looking at a chart and saying, oh, we've had an upside breakout in copper, therefore that means this, that, and another thing. And if gold goes up, so silver will do this, and interest rate will do this, and crude oil. And they look at charts and they create this macro based on charts. I'm not a believer in that. I'm a believer in looking at a chart on its own basis and going from there. I can't trade the copper market in the Bitcoin exchange. I can't trade gold in the soybean pit. And so for me, I have to look at each market and then create a narrative. Now, I'm a Bayesian. And so as a Bayesian, I create a macro bullish narrative in a macro bearish narrative. Then I want to see what price does. And so at least I'm trying to interpret price from the standpoint of binary narratives. Now, what could be massive narratives that could occur in Bitcoin at the convergence of the big banana? What happens at the stem? Interesting conjecture. I mean, I think we can postulate. I don't think we know. I'm not sure I would take anything I would say with regards to conclusions seriously. But as a Bayesian, as you take price and verify certain events, you start creating a situation where you start confirming narratives. That's
Yeah.
where narratives come into play. What could be the narratives? The narratives could be the collapse of fiat currencies as we know it. We're absolutely in a shakeout, a global shakeout of economies, which again doesn't change my attitude about equities long term, but could definitely change how we look at global currency reserves. U.S. dollars is stable in global currency reserves. What if that changes? What if 20 years from now there is a standard for global currency reserve that consists partially of the U.S. dollar, partially of the euro currency, partially of gold, partially of crude oil, partially of Bitcoin, and there is a basket that is created after some sort of global economic shakedown of central bank systems, where all of a sudden Bitcoin becomes central to the world's economic situation. That point, you blow out of the top of the banana. The banana is resolved. That's where the $1 million Bitcoin guys get their story.
Yeah.
But I think it's going to take an awful lot of energy in a big event for us to come out of the banana. Otherwise, it just drips sideways in a increasingly narrow band for some indefinite period of time. What could blow it out of the bottom? Who knows? I mean,
but I think you're that it's such an important thing you just said, because if we think back to the S&P chart, it is possible, people forget this, for markets to go sideways for a long time. So just because we're reaching this stem doesn't mean it can't be a really long one. Or if you don't want to think of it as a stem, you can think of it as a coiled spring, but it doesn't mean it explodes and unleashes. It could be like that for a while. There could be that pressure building for a long time. So that's, I think, a really important. And again, this is why it's good to look at things through the lens of history sometimes.
Yeah, I mean, these lines never do converge. I mean, they just narrow and narrow and narrow. But what happens if in the new age of computing in the future, you get one hack on the Bitcoin architecture? I'm not talking about some of Bitcoin being hacked. I'm talking about the basic architecture of Bitcoin itself. Now, people I talk to who are really knowledgeable say that's not going to happen. But there could be some things that could see this banana break to the downside.
Yeah, so they could break either way.
Yeah, it could go either way. And I have Bayesian narratives for both.
Yeah.
Now, a lot of times when we create the narratives, it's fun to create these narratives, isn't it, Maggie?
It is.
But I think when we do so, we have to do so kind of tongue in cheek. We have to create these narratives and say price needs to verify these things. History needs to verify these things. But always it's fun. It's always fun as a trader to create what ifs, right?
Yeah.
And so I could create also a what if that at what point does Bitcoin become fairly valued? What should be the price of Bitcoin? What we do in these markets is price discovery. Traders are involved in price discovery. New York Stock Exchange is involved in price discovery. The CME does price discovery. Bitcoin does price discovery. At what point is Bitcoin fairly valued? And then as a stable replacing or joining some sort of global reserve system appreciate just as the stock market has appreciated at 4.2% per year relative to inflation. What if Bitcoin reaches that point at which it becomes fairly valued, and then we see Bitcoin also trade within a 40% band one way or the other for forever, but it becomes a true store of value in that over time it'll appreciate and have some appreciation over and above CPI, but not greatly so. So anyway,
that's the middle scenario. That's the middle kingdom. That's the middle kingdom. Yeah,
that's the middle kingdom. I do want to look at gold too,
Yes, let's
because
do
of
it.
course, many people look at that as a store of value. Now, I've seen people that'll look at gold and show, here's the rate of return of gold over time. And of course, they start from some low point of a bear market in gold to some high point, and they overstate their case. I've also seen people go back and say, hey, gold traded at basically 2000 and 2011. Well, you take gold at 2000 or 1900 at 2011, and you compound it out to where it is right now at, the low threes, it's not a spectacular performer. But again, I think the same way about Bitcoin potentially as I do about the stock market. I think gold is a store of value play, that over time, gold will have periods when it's an investment, but over time, gold is a store of value. There are times in the stock market, in particular asset classes, where equities are a marvelous investment, but over time, they're a store of value. And so you have these things, Bitcoin, gold, U.S. equities based on high quality companies, where over a period of 10, 20, 30 years, they become store of value plays. But within a band that occurs in those markets, there are investment opportunities. And so I think the same way about gold. We're in a bull market run here. I think the bull market run continues. Interesting. I have a trade on right now, Maggie, where I'm short gold, long S&Ps. And I did it because the charts indicated that it was a good play. But, I'm not married to that. I could get divorced to that marriage real quickly. But for right now, I see S&Ps gaining on gold. I think over a little longer period of time, especially if we see central banks trying to continue to pump the system full of assets, liquidity, and you see the stock market going into a big, broad trading range and gold continuing higher, I think gold gains on S&Ps. Over the next 5 years, I think gold gains on S&Ps. So I think this bull market is going to have another run. You can see on the chart here, we're coiling up here. And we're coiling up probably, I think, for the last gasp upward during this bull market phase in gold. Then we correct somewhere down the line. Yes, the gold bulls will get their way again. And, but again, I look at all of these major assets as long-term store of value plays within which we can find investment opportunities, particularly when they're on a run and we're a momentum trader or we're a value trader and we're waiting for big corrections against the mean in any of these asset classes. Again, so you're 20, 30 years old, 80% SPY, 10% gold, 10% Bitcoin. That's my model.
So let's talk about treasuries, because it sounds like all of those things are a store of value. I don't know. Are U.S. treasuries a store of value anymore?
No, this is the 2-year. Everybody looked at the 10-year. I looked at the 2-year. The Fed would do a better job managing interest rates if it just would make its fixed rate the 2-year rate, Maggie. That's the reality. If you want to know what the Fed is going to do, just look at the 2-year. If the 2-year is going up in yield, the Fed's going to hike. If the 2-year is going down in yield, guess what? The Fed's going to go down. The Fed just hasn't got enough sense in its PhD brains to understand that it can make life easier and just decide that the 2-year note is going to become the fixed U.S. rate. It would save itself a lot of work, and taxpayers would save millions of dollars paid to these PhDs who are usually always wrong in their prediction, especially in their forward guidance. And so I looked at the 2-year here. This, by the way, is such a classic. I'm a classical chartist. I'm an Edwards and McGee 1934 chartist patterns. Left shoulder, complex head, right shoulder. This is a classic head and shoulders top. I don't know why. I don't know how. I don't need to reconcile it with every other market in the world. But I look at this chart and I think we go back to 2.4, 2.5 in the 2-year. right now we're 3940. That's a
Mm,
big move.
mm.
We're talking about taking the 2 years from 4% back to 2.5. So I think that's where the Fed is eventually going to go.
Do you think the longer end remains elevated? Are you concerned? There's been a lot of
Yeah,
talk.
no, I think we need to put that back. I think we need to put carry. We need to get out of this inversion, and we have been. We've been moving out of the inversion. Of course,
Mm,
with the longest period of time of rate inversions on record, really. When you look at the inversions we've had, we're starting to correct that. We're starting to put some premium back into the 10-year, into the 30-year. We're starting to see the long end of the yield curve probably stays about where it is, maybe goes down. I mean, if you take the 2 years back to 2.5, you're going to have some movement to lower rates in the
mm,
10-year, but not necessarily a whole bunch, because I think basically what people are going to say is, hey, I happen to have one narrative in my head which agrees with Ray Dalio, which basically says we are going to have bankruptcy in the U.S. And so, as a Bayesian, that's a narrative that always is kicking around in my brain. And so, when you see something like that, of course, then you have skepticism on who's going to own U.S. debt. And so
mm.
you see some sort of, at least at the long end of the curve, not a big willingness to own long-term U.S. debt at low rates. And so that's why I think that we have a yield curve trade here. I'm not in the yield curve trade, but we do have a yield curve trade where you basically want to bet the 2-year, 5-year against the 10s and the 30s. So I think for those people who are trading the yield curve, we're going to go back to the more traditional yield curve where you're lower at the front end, higher at the back end on the yield.
Mm. Any commodities that catch your eye right now, or that you think are interesting, or maybe have some alpha?
Uh, yeah, I mean, gold still has a little play in it. Hey, grain markets are extremely cheap right now, and they're cheap because we have grain. We've got too much grain, but in commodities, there's an old saying, and that is, there's nothing that cures low prices like low prices. Nothing that cures high prices like high prices. As you get high prices in commodities, you get overproduction, especially in those things where production can be turned quickly. Grains are an example. Livestock, particularly when you get into chickens, you can turn that production cycle real quickly. And so, but I like grains long term. I just think we're not there yet. Of course, there's been there's always been silver bull. The craziest people out there in my mind are the silver bulls, because when you have a bull market in silver, it's destiny. When you have a bear market in silver, or silver price don't go up, it's manipulation. I mean, there's just all kinds of wacko thinking among the silver bulls. Silver, people have to remember, silver is only partially a precious metal.
Mm.
Silver is mainly either a collectible or it's an industrial metal. And also, the higher the gold price is, the more you mine for gold. Silver usually is a byproduct.
Mm.
There are some silver mines. There are some mines, they are after silver. Most silver is produced as a byproduct. So you start hiking the price of some of these rare minerals, of gold, of platinum, and you're going to see increased production of silver. Also, you tend to see the recycling spike up in silver, and so that moderates things. So, yeah, I mean, silver people are talking about we go back to 50, then we go to 100, then we go to 150. I think they're dreaming. I mean, some of these people are saying, well, silver needs to be priced, gold needs to be priced at, 18 times the price of silver. So, we need to take the gold silver ratio from the current levels of 90 or wherever they are today, back down to 50, and maybe back down to where some king of Spain declared them at 20 back in the 1400s. Well, I'm not a buyer of that, And so I really have no interest in silver other than just to trade it periodically. To be a holder of silver to me is insane. But that doesn't mean to say that we may not see a somewhat of a bull run in silver. So I like that, like the grains. I think commodities in general will gain on equities over the next 10, 15 years. If someone wants to have a really interesting look at commodities, they should go and look at long-term charts of like copper, corn, cocoa, sugar, those type of markets. And what they'll see is prior to Bretton Woods, 1971, we had extremely low stable prices in a narrow range. Now, then we went from 1971, 72 bull market in raw materials up to the mid-2000 bull markets. And we created another price band, another range that was well above the pre-Bretton Woods 71 range. Now, what we've seen that the last 20 years, we've created another range for all of these raw material markets. So we had the pre-Bretton Woods, we had the 1972 through mid-2000 range of prices, which were stacked at a little bit higher. And I think that something's going to happen here in the next 10 years where we're going to see really a repricing of all raw materials upward. Meg, I started trading in 1975. I joined the Chicago Board of Trade. I traded corn prices in the 1970s at the same price that I can trade corn at today.
It's crazy.
That's just insane.
Yeah.
I could trade sugar. I traded sugar in the 1970s at a higher price than where sugar is right now. And so I think something's going to happen. Could be weather. Who knows what happens?
Well,
but somewhere in the next 5 years, we're going to have a bull market in commodities.
Amazing. We have a lot of extreme weather to deal with. So I know you have some conclusions, Peter. What would you like to leave us with?
Yeah. Conclusions for the next 5 years. U.S. dollar trends lower against other foreign currencies. Again, don't get trapped into this comparing the price of USDX, U.S. dollar index, and think of that somehow as a value in and unto itself. It is not. The U.S. dollar value is only important relative to other foreign currencies and relative to purchasing power. And so the U.S. dollar level in and of itself basically means pretty much nothing. So we see U.S. dollar index trends lower somewhat. And again, think about lower. Think about that. The 54 years, 17% change. So I'm not looking for anything big dramatic against other currencies, but lower. Purchasing power of the U.S. dollar goes lower. That'll always go lower. The only sure bet I know is to be short the purchasing power of the U.S. dollar. And you do that, again, by picking your spots in gold, by picking your spots in Bitcoin, by picking your spots in quality equities. That's how you maintain purchasing power. U.S. equities to go in a broad 40% range, whether that's S&Ps at 5,500, and we're getting close to the top of the range here, or it's S&Ps at 6,000. Pick your poison. But I think equities go into a broad market with occasional real bull market runs in selected NASDAQ type stock. Japanese stocks going higher, some European indexes going higher. Bitcoin facing their great reckoning, the big bananas coming up. Okay, what happens when we get to the stem? We're getting close. Gold goes sharply higher, particularly, I think, against equities. U.S. rates, man, that's the big guess. That's the big guess. And I've even seen Ray Dalio say that ultimately, if the U.S. goes bankrupt, ultimately one of the ways out is going to be much, much lower rates. And so, I can create a narrative for higher rates. I can create a narrative for lower rates. For me, I want to see which way the charts play out. I'll go with the charts. I'll always go with the long-term charts.
That a little more comforting watching that than Congress, Peter, and that's going to have a big determination of what happens to those rates as well. Peter, I can't thank you enough. It is so wonderful to get your perspective, and you're so thoughtful about this. And I think it's great advice for people who are starting out and also people older who may need the money. Looking at things through that store of value, I think, is a much easier way to think about whether you're ready, whether you're operating in the right time frame, and whether you're properly diversified. So just absolutely brilliant. Thank you so
Think
much.
long term. Think long term. People need to get out of this short termism, which is increasingly dramatic. What we see in things like the Robinhood, in some of these altcoins, in this simulated futures trading industry, is we're seeing a generation that's getting, hey, they're not looking at monthly charts, they're not looking at weekly charts, they're looking at 1 minute charts. They got to move away from that. They got to become, they downplay guys like Warren Buffett, like Stan Druckenmiller, who, frankly, I think Stan Druckenmiller is one of the two best traders of my lifetime, the other being Bruce Kovner. But yeah, I mean, you don't need to, these guys that talk about 10x, I did 10x this year. That's great. You're going to lose 10x in the future. And so you need to think long-term opportunities, big time horizons. But yeah, you stay in the moment, you consider your alternatives. I think those are the guys that rise to the top.
Peter, fantastic stuff. Thank you so much.
Thank you, Maggie.